You know, the stock market right now feels like it's in a massive tug-of-war. On one side, you've got this incredible optimism pushing things higher, but on the other, there's some pretty serious risks hiding just under the surface. Today, we're going to dive right into this high-stakes balancing act in the S&P 500.
Okay, let's start with this number, $6,484.75. This was a recent closing price for the S&P 500 E-mini futures contract, which is basically one of the most important tickers that traders watch. But what does a number like that really tell us?
Well, it tells us that the market is showing some incredible strength. We are literally hovering just a stone's throw away from breaking all-time records. After a bit of a shaky period, stocks have come roaring back, and a lot of investors are starting to wonder if a huge new breakout is right around the corner.
So what's the fuel in this engine, right? What's pushing the market up to these incredible heights? Is this whole rally built on a solid foundation, or is it just a house of cards waiting for the next gust of wind? Let's break it all down.
The main story here, really, it all starts with one institution, the U.S. Federal Reserve. A recent shift in tone from its chairman has totally changed the game for investors, leading to what everyone on Wall Street is calling the September bet.
Right now, you could argue that almost nothing matters more to the market than what the Fed is going to do with interest rates. After this long, drawn-out fight against inflation, the entire investment world is now laser-focused on one thing, a pivot to cutting them.
And listen, this isn't just some wishful thinking. This number here shows real conviction. The market is pricing in a staggering 90% chance that the Fed will cut interest rates in September. That is a massive, unified bet that cheaper money is on the way.
This whole expectation is what traders call a dovish policy. And when the Fed gets dovish, it's kind of like a green light for the stock market. See, lower interest rates make it cheaper for companies to borrow and grow, and it also makes stocks look way more attractive compared to safer things like bonds.
So, you've got the most powerful central bank in the world seemingly on your side. It's no wonder investors have plenty of reasons to be optimistic. Let's build out the full bull case for why this rally might have a lot more gas in the tank.
The pros are looking at what they call a bullish cocktail. You've got that supportive Fed we just talked about. The health of the rally itself seems to be improving. Financial conditions are pretty loose, making it easy to get money. And maybe most important of all, corporate profits are expected to keep on growing.
Let's just double-click on one of those ingredients for a second, market breadth. Think of it like a checkup for the rally. A really healthy rally is like a rising tide that lifts all the boats, not just a few giant mega yachts. You want to see broad participation, right?
And guess what? That's pretty much what we're seeing. Right now, about 71% of all the stocks in the S&P 500 are trading above their 50-day moving average, which is a key short-term trend indicator. This suggests the rally is getting broader and healthier, and it's not just riding on the coattails of a few big names.
Okay, that all sounds fantastic. But remember, this is a balancing act. For every powerful argument for a soaring market, there's a counter-argument pulling it right back down. So let's flip the script and explore the reasons for caution.
And this is the big question, the one that probably keeps professional investors up at night. Are we all cheering for a sustainable climb to new heights, or are we ignoring some major cracks forming just below the surface?
The central debate really comes down to valuation. On one hand, the bears will tell you that a forward price-to-earnings ratio over 22 is just way too expensive compared to history. But on the other hand, the bulls argue that, yeah, it's justified if the Fed cuts rates and corporate earnings grow by 10 to 13%. And that is a very, very big if.
Another huge risk is concentration. I mean, even with that improving breadth we talked about, the market is still incredibly top-heavy. The 10 biggest companies make up about 38% of the entire index's value. That means a little bit of bad news for just one or two of these giants can have a massive negative impact on the whole market.
And there are other potential storm clouds on the horizon too. Strategists are worried about the possibility of new trade tariffs next year. They're worried about any disappointing news from the all-important AI sector, and a sudden spike in bond yields could make stocks look a lot less attractive almost overnight.
So, with this clear tug-of-war between the bulls and the bears, how are the big money managers actually handling this? Well, they don't just guess. They have a game plan, and it's all based on watching a few key price levels.
For the pros, it's all about these levels right here. That 6,500 area is the ceiling. The market needs to smash through that to really unleash the next wave of buying. But the real line in the sand right now is down around 6,270. As long as the market stays above that support, the bulls are still in control.
This all builds into a pretty simple three-step playbook.
Step 1, you stay bullish as long as we're above that 62.70 support level. Step 2, you actually use any dips or pullbacks toward that level as a chance to buy. But step 3, and this is the crucial one, if that level breaks, that's your signal to protect your profits, reduce your risk, because the whole trend might be changing.
Now, this tug-of-war can't go on forever. Sooner or later, something's got to give. And there are a few key events coming up on the calendar that are likely to decide who wins this fight, the bulls or the bears.
So keep an eye on these dates. On August 27th, we get earnings from NVIDIA, which is the bellwether for the entire AI story. That's followed by key data on economic growth, and then, crucially, the PCE inflation report. That's the Fed's favorite inflation gauge. And all of this is building up to the main event, the Fed's interest rate decision in mid-September.
So there you have it. The battle lines are officially drawn. Over the next few weeks, we're going to find out which force is stronger, the incredible pull of lower interest rates or the simple gravity of high valuations. The answer is going to decide the market's next big move.